Almost every financial advisor tries to put you in a 60% stock, 40% bond portfolio as you approach retirement. This has been the industry standard since the 1950s, but in today's market, the truth is it's outdated, it's underwhelming, and it is borderline broken. I'm Terrell Higgins, your real estate and personal finance guide, and in today's video, I will be explaining why the traditional 60-40 retirement portfolio does not work anymore, and I will be giving you two alternative portfolios that outperform it in every meaningful way. Let's get into it. So what is this 60-40 portfolio anyway? The idea comes from the modern portfolio theory that was introduced in 1950 by Harry Markowitz.
He suggested that I should maybe do a dissertation on the stock market. So I went in.
A stockbroker gave you the idea
Yeah,
too?
that's right. That's right.
A tip that paid off.
Yeah.
And the idea around it is that if you mix uncorrelated assets like stocks and bonds, you can reduce your risk without killing your returns. So portfolio managers started putting 60% stocks into portfolios so you can get growth, and then 40% bonds into portfolios so you can introduce safety. And back then, it made sense. Bonds got between 5 to 7% interest, and they would zig when stock zagged. But that's just not the world we live in anymore. In theory, bonds are supposed to protect you when stocks fall. But in 2022, this fantasy exploded. The 60-40 portfolio had its worst year since 2008. And the biggest losses, they didn't come from the stocks, they came from the bonds. The long-term treasury bonds actually fell 30%.
No, don't like that.
So the so-called safe portion of your portfolio actually betrayed you.
Emotional damage.
Why? Because bonds are very sensitive to interest rates. And as interest rates go up, like they did when the Fed started hiking rates to fight inflation, bond prices actually go down. We are not in that low interest rate environment anymore, and it's very likely that the Fed's going to keep interest rates higher for longer. So that 60-40 portfolio is carrying more risk than you think, and it's not delivering any real upside for returns. So let's look at the actual numbers here. So we're going to be pitting a traditional 60-40 portfolio against an alternative portfolio. So for that traditional 60-40 portfolio, we're going to do 60% stocks. And for that, it's going to be VOO, which is the Vanguard S&P 500 Index ETF. And then that 40% is BND, which is Vanguard's Total Bond Market ETF. And the portfolio we're going to be comparing it to is a 60-40 stock gold portfolio. And once again, that 60% is VOO. And then for gold, we're going to use IAU, which is the iShares Gold Share ETF. So from 2016 till now, that 60-40 stock bond portfolio got about 8.9% per year. But if you compare that to just holding the S&P, you would have got 13.4% per year. So you're giving up almost 4.5% in gains every single year by being in that 60-40 mix. And if we look at the downside of this portfolio compared to the S&P, in the worst year, the S&P dropped 18.17%. And if we compare that to the 60-40 portfolio, the 60-40 portfolio dropped 16.16%. So it's saving you about 2% in losses. But if you're missing out on 4.5% of gains, but it's only saving you 2% in losses, you can do the math here. You're not coming out ahead. Now let's look at the stock gold portfolio. So one thing that stands out right away is that your returns are nearly identical to holding the S&P 500. But on the downside for this 60/40 gold portfolio, in that worst year, it's saving you from 7% of those potential losses. So you're getting about the same level of returns. And when the market goes south, it's saving you 7%. And you can really see it in these risk metrics. In the Sharpe and Sortino ratio, that traditional 60/40 stock bond portfolio has worse risk return metrics than if you just hold the S&P, and that 60/40 gold portfolio has better risk return than the S&P. So you are getting better performance with less risk. And the last thing to note is how closely correlated to the market these different portfolios are. That stock bond portfolio is nearly identical to holding just the S&P 500. So it's not really eliminating your correlation with the market, where that 60/40 gold portfolio is giving you a much bigger difference in the correlation between the stock market and your portfolio. The 60/40 portfolio isn't just underperforming, it's lazy. It assumes every investor is the same. Same risk profile, same goals, same timeline. It's like a doctor giving everyone the same prescription without running any tests. Your goals might include early retirement, generating real estate income, creating generational wealth. So this cookie cutter portfolio from the 1950s doesn't take any of that into account. So let me show you one more alternative to that 60/40 portfolio. And this is where it gets spicy. So it's a 60/30/10 portfolio. 60% is in stocks, 30% is in gold, and 10% is in crypto. So that 60% is still VOO, that 30% is still IAU, and for that 10%, we're going to use GBTC, which is a Bitcoin ETF. And despite what you might think about cryptocurrency, this portfolio is a beast. You're getting nearly double the returns of the S&P 500. Your drawdowns are nearly identical to if you were just holding the S&P 500. But if you look at these risk metrics, it's where it really shines. You have almost no real correlation with the market, and your risk to reward ratios are through the roof. That gold is acting like a real hedge, that Bitcoin is acting as an asymmetric investment to give you outside returns, and this asset diversification that modern portfolio theory was actually looking for is being delivered by this 60/30/10 portfolio. Look, if you are planning for the future, your portfolio has to evolve with the times. And that 60/40 portfolio, it may have made sense when gas was 30 cents and pensions were more common, but in today's market, it is an absolute relic. And if you've made it this far in my video, please leave a like on the video, subscribe to the channel, because I give no nonsense, fact-based advice like this every single week. And if you are freaking out in today's market environment, it might be because you didn't watch my video on what you should be doing in very volatile markets. Thanks for tuning in, and I will catch you guys next time.